Hey Insurance, this is Tony Cañas, Chief Motivational Officer at Insurance Nerds and PNC Client Advisor at the Jacobson Group. Today, I want to talk to you about why I don't care about insurtechs as investments. There, I said it. Over the last 10 years or so, the insurance industry has seen some $20 billion of venture capital come into the industry to either try to disrupt us or to provide us with better technological tools. As is to be expected from any venture-backed startup, 80+% will ultimately probably go out of business, and out of the remaining 20%, most will probably get acquired, and only a few will go public or IPO. Even out of those few that IPO, some might not survive in the long term. For the purposes of this discussion, let's separate insurtechs that are aiming to become independent full-stack carriers from those that are aiming to provide a technology tool to the insurance incumbents or some other sort of play. Today, I mostly want to focus on the full-stack insurtechs, especially those that have gone public. Much digital ink has been spilled analyzing the post-IPO performance of Hippo, Lemonade, and Root. Even in my own Insurance Nerd Slack channel, there seems to be an obsession in our community with the financial performance of these companies. Personally, I didn't invest a cent in any of these companies or any other insurtech, nor did I bet against their success using any sort of options. Personally, I invest the entirety of my portfolio in low-cost index funds. So I guess a small portion of my portfolio is invested in those three. I find this obsession with their post-IPO financial performance to be very interesting because that's just not the way I think about insurance companies, both incumbents and insurtechs. I fully understand that every insurance company eventually needs to show a profit in order to survive. This goes for both publicly traded and even mutual companies. In order to take care of our customers for the long term, we must produce some level of financial profits at some point. As of October 31st, 2021, when I'm recording this video, Hippo started trading on January 15 of 2021 at $11.85 per share and is down 64.14% all time with a close of $4.25 per share on the last workday before I recorded. They have never traded above $14.07 per share. Lemonade started trading on July 2nd, 2020 at $69.16 and is currently down 10.45% all time as of the close of market on Friday with a stock price of $61.16 per share. It did briefly trade above $160 per share earlier in the year. Root started trading on October 30th, 2020 at $23.97 per share and is currently down 80.64% all time as of close on Friday at $4.64 per share. It has never closed a day above opening price. I get it. They haven't performed well in the stock market thus far. None of the three. But from my perspective, the important and interesting part is how well insurance companies do three things. Number one, how well do they take care of their customers for the long term? Number two, how well do they treat and invest in their employees? And number three, are they leading the way when it comes to important issues like DE&I and climate change? I personally don't care how they perform as investments because that is not their primary role in society. They need to be good enough financial performers to survive, but it shouldn't be the primary measure of their performance. And I think that our obsession with the financial performance of the insurtech carriers obscures these more important characteristics. Ultimately, Hippo, Lemonade, and Root, and those following in their footsteps must be able to show enough of a profit to survive. But that should not be the primary way we look at them. There are other much more important characteristics in the long term that matter a lot more to society. Let's not forget that. That's the whole reason that I wanted to make this video. Yes, I get it. They have to eventually show a profit. And there are arguments to be made on both sides on whether they've been successful or not doing that, and whether they will ever be successful or not doing that. That's fair enough. From my perspective, I don't want to muddy the waters, but from my perspective, from what I've studied, it takes a long time to get a new carrier to profitability. So I'm not surprised that they've had trouble thus far creating a profit. And maybe that's not even what they were created. What I mean by that is maybe they were created to be an acquisition target, not to be successful long-term IPOs. I don't know. I have no inside knowledge on any of those companies. But all I'm saying is, let's not drown in the overanalysis of their performance as an investment when there are much more interesting things and much more important things that insurance companies do for society. Thank you. I hope that this was interesting.